The markets have begun the next leg down, and it's looking like it could get really ugly. Welcome back to Markets for Millennials for the weekly analysis from October 10th through October 14th. And I just want to remind you to hit the like button and subscribe to this channel if you haven't yet. I also want to mention, if you want to follow me on Twitter, you could follow me at Mr. J. Thomason. I'm the one who runs this account on YouTube. And if you also want to, in my Twitter account, you can subscribe to the newsletter. It's a free newsletter, and I post lots of charts. I do a review of what happened last week. I take a look ahead at next week through the lens of the strength and momentum signal. I also pick a stock that I'm watching, and I also provide some learning in there. So if that's something you're interested in, go ahead and subscribe to those things. But on to the charts. As I said, the next leg down has begun. I wanted to start with looking at the 10-year Treasury yield, and we have finally gotten a close above 4%. And I think back, to this area where I was definitely one of the people as we were consolidating this direction that was saying I didn't see yields going above 2%, and obviously a lot of stuff has changed, and I got rid of that bias once we bounced off of the support here in December, and yields have continued up since then, and so we got the close up. Wanting to check in with a couple of the yield curves. Let's see here. I want to go look at this yield curve. So the 10s and 2s yield curve has been inverted for a very, very long time. We actually hit the deepest level of inversion in a good while. I can't even remember the last time we were, just on my own analysis, the last time we were inverted this far. Yeah, on my TradingView chart, I don't even see a time where we were inverted quite this much. So obviously that's a really big deal. But obviously this yield curve is low-hanging fruit. The most important one is the 10-year 3-month Treasury yield curve, and this has come down this week. We are at 291 or 0.291% on the spread there, and as far as the recession goes, this yield curve is the more accurate recession indicator, and we have not yet made that close below, so that's going to be something you're going to want to watch. Also deeply inverted is the 30-year 5-year. A lot of people look at this one as well. This isn't looking like it wants to roll over even further, so it's really interesting because the signal here that you get from the 10-year 3-month curve is that we are not quite ready to say that it's time to go into recession yet, so that's going to be something we want to keep an eye on. But because of what's been going on in the Treasury market, a lot of people have been looking for a top in yields, as a lot of people have been looking for a top in the dollar, because we've seen intervention from the Bank of England, and we've seen how they have basically reversed course and gone back to QE, although that was to end today. And so a lot of people assuming that because sovereign bond markets are blowing up in Europe, which I think is much more complicated than maybe people give credence to. But in any case, a lot of people have been expecting a pivot. A lot of people have been expecting a sell-off in yields. I was even expecting a sell-off in yields. When you look at the yields on the 10-year from the perspective of the strength and momentum signal, we got some extensively overbought readings, some exhaustion readings, and I was expecting this to come off a little bit more extensively. When you put this trend line back in here, we actually broke down from a really significant trend line, but it was a fake breakdown, and we're right back above that trend line now, and I'm still bullish. We have a positive volatility signal. And so this actually could go up quite a bit. And I think now that we've made the close above 4, I'll be interested in seeing if we get continued consolidation sideways or if we're just going to continue to push this vol range up. But in any case, that has been putting extensive pressure on the markets, and specifically putting pressure on the NASDAQ and the big tech names, which have benefited from low yield environments for a really long time. And so the multiples are being destroyed by the rising yields, and so that's why you're seeing, the Nasdaq's down more than 3%. That's obviously the biggest drop out of the major equity indices. And so what was really interesting was if I go back to my let me go back to the yield chart. No, yeah, we'll do the yield chart. Yields really moved up high yesterday on the CPI print. CPI came in higher. I don't have the metrics up on my computer to show you right now, but the CPI did come in higher, which was not a surprise considering the PPI was also hotter than expected. And so what was really interesting, though, and the best image to show you is on the NASDAQ. Let me get rid of the drawings for a second, because we had this massive wick down. In fact, let me pull it up on let's do a 5-minute chart. So if you go back to the CPI, in that 1 minute, we just had this massive drop on the CPI release because of because it was above expectation, and core CPI especially. And we stayed down for all of about an hour and 10 minutes or so before starting the rally up, which obviously, there was a lot of discussion from the Bank of England and the Eurozone about intervention and things like that, and the markets got really happy about that. And that little bounce lasted. We went from, it was a really huge swing. If you look at it from the perspective of the NASDAQ, it was basically a 500-point swing. I think it was more than 500 points actually, from the downside to the upside, and where we closed. And we basically gave all of that gain back plus more today. Didn't make a lower wick low, but obviously I wasn't expecting that. So everybody right here was expecting kind of something similar to what we got back here, where we had the CPI in July released for June, and we had come down and then actually closed almost near break even, and that ended up continuing this little run that took us into August. A lot of people were expecting that because of the bearish sentiment, and obviously that didn't come to pass. And if anybody was actually looking at the technicals, you would have seen that the NASDAQ particularly had a lot of work to do to get even a repair bounce going. As you can see, I have these 3 trend lines that are marking declines in price, and we didn't even get above the first trend line. And so, in fact, we came up and got right under it, basically touching it, before getting rejected. And what I do want to say, though, is what was not surprising to me also, let me get rid of that. What was not surprising to me was that we did get a little bit of a reaction bounce off of that level, because I don't have the video up. I did post about it on my Twitter account. Once again, you can follow that Twitter account if you want to see the charts and things that I post. But I basically had, if I go to my object tree, back in May, I had put up these rectangles. May, that was kind of around this level. And I was talking about where price was likely or could be likely to see a bounce, so the ranges that you could see price bouncing. And I was taking those levels from our September and October 2020 peaks, and then those little bounces. And I was suggesting that I could see us getting down at least. When I put these there, I was looking originally for the bottom of these bear markets. And I was suggesting back in May that we could probably get to this lower yellow band. And sure enough, here we are. And to be honest with you, I don't see this changing anytime soon. I don't see it getting better anytime soon. So it looks like we actually could go lower. And I'm starting to think that we're going to go potentially get close to our pre-COVID highs, which are down below 10,000. It doesn't seem all that unreasonable now, but I'm not trying to get too bearish. I'm just following price and positioning for the range of possible outcomes. But I'm just saying I wasn't surprised to see the little bounce here. And if you actually go check out that video and you look at my levels for the S&P as well, you kind of see that the green area, which is the higher area. Obviously, the yellow box. Here we go. The yellow box is the lower area. We're not there on the S&P or on the Dow or on the Russell. But you can kind of see we converged on those levels around the same time. And so my point is it wasn't all that surprising to me to see We got basically 2 bounces on that on the S&P. Didn't quite give back everything. Well, we're right about there. Yeah, almost a no change across these 2 days. But kind of resting on that. That's a pivotal spot to be on for the S&P. But we did continue to make a lower low from our June low. As far as on a closing basis, we are still below those June lows. We failed to get above the descending trend line here. That's obviously a signal that this market still wants to go lower. The same kind of thing, well, not quite the same kind of thing happening on the Dow. We did get above and close above the steepest trend line and have so far come in for a retest, and we are above the green support zone, which is actually marking the pre-COVID highs before the February-March 2020 crash. So that'll be interesting to watch that level. In fact, what it looks like on the Dow, you're starting to see, is it looks like we're going to get some kind of maybe wedge pattern or maybe a flag pattern. If I erase that and maybe do something like that, we might get a flag pattern there. That'll be something to watch for, most definitely. But in any case, this is looking pretty bearish. In fact, I'm gonna delete that trend line so that it's not a distraction anymore. The Russell is the only index that still hasn't made a lower low from its June lows. But I want to again show you here the green band is a lot thicker here because it's covering a zone from the pre-COVID highs as well as our bounces in August, or the bounce peak in August. So it's a little bit of a different range, and you can actually see that that level provided some support all throughout, and it's been a zone where a lot of people have been buyers. You have to remember that support and resistance are not always just clean straight lines. They are often zones, and so this green zone has been a buy spot, and probably right in the middle of there, if you actually see the crosshairs, if you look really closely, you can see that our little top from October 2020 is where we bounced back in June, and it's where we've been kind of bouncing all throughout end of September and so far in October. So those are levels that you should be aware of. It is looking very bearish. It's hard, I mean, other than maybe because of sentiment and positioning, it's hard on this reversal today. It's hard to see markets being poised to run to the upside going into next week. So I would be watching out for that. The dollar, I'm going to show you what I'm watching here. The trend is up, right? Trend is your friend. The trend is up. I want to just mention that the pattern that I'm watching for is happening in this, what I've already kind of made this wedge pattern. This is derived out from, actually, if I go see if I can find it really quick. I posted this on Twitter. This is the pattern that I'm watching for. I'm not sure if it'll be exactly, that direction. That's the direction that I have made this wedge. But that's kind of what I'm expecting to happen. I'm not sure where the markets will go if it consolidates like this. After today, it looks like this could just bust out and just keep going to the upside. But I do want to be aware that this could consolidate like this, bouncing on the horizontal level from September 6th, which is where we came down to on October 4th and bounced off of. I want to be aware that that could totally happen. And if the dollar does consolidate, then what I just said about the equity indices bouncing could actually still come to fruition. We could actually see the S&P go on a bounce and either bounce off of this shallow trend line or even bounce up close to 4,000, 4,100 again. Those are entirely possible, and you want to be you don't want to put all your eggs in one basket and just assume that price is just going to instantly drop and that the bottom will fall out. You want to be positioned in case, or be able to be nimble enough to position in case of a bounce to take advantage of that. So you got to watch your levels and properly manage your risk. So on the dollar, though, if you look at it from the perspective of the strength and momentum signal, kind of been toying with bullish and neutral levels we have closed back into bullish, and we're actually not too far from the middle of the volatility range. And so I just want to be aware of that. You actually do see the outer bands of the volatility range are narrowing. And so you can actually see across the last year, when you see that volatility range starting to narrow, it's usually right around consolidations, when consolidations are starting to happen. And then, of course, they typically resolve into some pretty significant move, either to the upside or to the downside. And so far, over the last year and a half, it's been to the upside. So that is something I also want to be aware of. I have taken long dollar positions, particularly once again versus the euro and the British pound. Let me just show you what that looks like really quick. I'm just using the dollar as a proxy, so I've been watching this level. So when we came back up into this resistance right here, or I'm sorry, so this trend line was right there, and then as soon as we sold back down, that was a prime spot to take a position with the stop loss right above this red wick. We sold back down and came back up, and so far have retested this level, and we're selling back down. So if you missed this spot to take a trade to the short side, again, I'm not saying that this is a guarantee, right? I'm not trying to be a hero and look like a genius, but I'm talking about placing trades based on the macro and then proper risk management. So you know exactly where this is wrong if you're taking short trades here, if price breaks above this line. So that's something that I was doing. I did the same thing on the euro and the US dollar. Just sharing with you kind of the same kind of trend line that I've been watching. Every time we've come up to take we've come up on this trend line or near the trend line, it's been an opportunity to take a trade. You might recall, if you follow me on Twitter, down here is where I, for the first time in a really long time, I took profits on my euro US dollar trades, and I figured I would start repositioning in after we got some relief, because when you look at it from the perspective of the strength and momentum signal, it's the first time in a really long time I actually didn't sell or didn't close my trades or take any profit on these other signals. But it had been the first time in a long time that we got a oversold signal. And I was also looking at the sentiment, and the sentiment was seemingly apocalyptic. So that was, I was able to make that decision. And so I'm just sharing that because I want to just show you how you use a combination of the macro, of indicators, and of sentiment, and you manage your risk properly around TA, and that's how you can become successful in the markets. I'm taking a look at Bitcoin. It was a little concerning, so I might have said this before, but I adjusted my descending trend line because I wanted to account for the fact that it seemed strange that we were still consolidating below. And when I did that, it created some extra space above this price action. And then it looked like we were busting above and breaking out of that trend line. But that's apparently not what happened. And so we actually sold back down below, so it's a fake breakout. And that's a little concerning. But we're getting to a point where, I can't keep adjusting this trend line and have it still be a valuable trend line. So we're getting to a point where Bitcoin's price action has to resolve. And if you look at it, again, from the perspective of the strength and momentum signal, I'm going to pull this back so you can see how small the volatility range is compared to the last couple of years. And then I want to go back and show you what happens typically when the volatility range gets squeezed like that. So I'm going to show you one example of the volatility range being really small right before the capitulation from November 2018 and into December. However, a tightening volatility range can also lead to explosive moves to the upside, like it did in 2020 in July going into August when the bull market was about to get underway. So my point is that when you see the vol range from the strength and momentum signal really getting squeezed really tightly, like look at this price action. We sold down, touched poked through the probable range based on the volatility indicator, and then came up on overnight this morning on Friday and got halfway from the midpoint to the top of the volatility range. And so there's just and the volatility range is still straight, like it didn't move, it didn't expand at all. And so that suggests to you that we're tightening up for something really big to happen. And just based on what I've been tracking with the multiplier and reduction tool that I created, my bias has been that we would come down and touch and cross the orange line. We haven't yet, and we might not, but until we either close above the green line or touch down below the orange line, we're in this no man's land. So I'm going to be watching that for myself going forward. Finally, gold, after getting a bounce, a pretty significant bounce, has once again come back down. We're in the lower half of the 1600 level. And so it just doesn't look very good. So far, this channel is still holding up, even though we technically did kind of get above it just on October 4th. And then finally, crude oil. I just want to point this out. I put this level last week. It was a little bit higher, but I adjusted it down over the weekend after thinking about it for a little bit. But we broke out, and I was looking for the retest of this descending trend line or of a retest of this horizontal level. I took a little nibble on Wednesday, thinking that this might be a spot to catch support and bounce up and continue to move up. It has since broken down and stopped me out. That's perfectly fine. Now I'm watching for, let me just, if I just kind of show you, I'm watching for price to come down to intraday wick below the trend line, but then close above. And if it does, then that's gonna be where I take another nibble on a long position there. And you can do that if you trade futures, or if you want to trade an ETF like USO or something like that that's in the oil market. So that's my look at the markets for this week. My bias is bearish to the downside. Be very careful chasing the downside momentum. Shorts are very risky. And if you want to take some opportunities to nibble on some positions, maybe some longs to prepare for maybe a small bounce, as long as you manage your risk levels, then you got to be willing to take those. And if you're going to take one, you have to be willing to take all of them, because the one time you don't nibble on the position might be the time that it gets away from you. So hopefully this video is helpful for you in the look at the markets. Hope you guys have a great weekend. Don't forget to like and subscribe. I'll see you guys next week.